Hello and welcome back to another video on inventory. I'm Dr. Rao. In this video, we're going to look at the gross profit method. This is yet another estimation method for inventory. So when would we use the gross profit method? When you need an estimate, such as for interim reports, it is acceptable to use the gross profit method, assuming that the gross profit ratio stays constant year after year. It may also be used if there's a catastrophe and which completely destroys your inventory or even your inventory records. So it's basically a way of trying to assess how much inventory you have on hand if you have to file for insurance claims. So let's take a look at an exercise. It's fairly simple and see how we would do this. So we have a company that is using the gross profit method to estimate inventories for their monthly reporting. This is for the month of May. They started the month of May with $160,000 in inventory. They have purchases of $640,000, freight in of $30,000, sales revenue of $1 million, sales return of $70,000, and purchase discount of $12,000. Now they give us two different assumptions. The first one is that we have a gross profit of 30% on sales, and the second is the gross profit is 30% on cost. We'll start with the 30% on sales. Whenever we talk about gross profit, we always assume it's on sales. So that's the assumption we're going to go with in the first case. So this information that has been given to me, I'm going to present it in two parts. So in the first part, I'm looking at, I start out with sales. And in the income statement, the next item I will have a sales return to give me net sales. I have sales of $1 million. I have sales return of $70,000, leaving me with net sales of $930,000. The next thing I would do is I would subtract cost of goods sold to arrive at my gross profit. Cost of goods sold is an estimated number. Now, what have I been told? My gross profit is 30% on sales. So if my sales is 100% and gross profit is 30%, it means cost of goods sold is 70%. I know one of these numbers, so I can figure out the other two. It's very easy. 70% of 930,000 is going to be my cost of goods sold. 30% of 930,000, or the difference between these two numbers, is going to be my gross profit number. Now, this doesn't help me to answer the question of what my ending inventory is. So now I move to the next step. I have this number, so I'm going to use it in the next part. And in the next part, what I'm going to do is I'm going to calculate how I arrive at cost of goods sold. So beginning inventory, to that we add the purchases for the current period. You will subtract purchase discounts, purchase returns. So in this case, I have only purchase discounts. So my beginning inventory was given to me at $160,000. The gross purchases are $640,000. I subtract $12,000 and I add freight in. And the freight in number is $30,000. Now that I have these numbers, I come up with my cost of goods available for sale. This is what is available for sale, $818,000. Now, my ending inventory, when I subtract it, I will get my cost of goods sold. Now remember, I know the cost of goods sold estimated number over here. I estimated it to be 651. I bring that number down over here, 651. And then I can plug this number in and say my ending inventory is estimated at it's $167,000. Excuse me, that one. Okay. So cost of goods available for sale less the estimated cost of goods sold gives me the estimated ending inventory. And that is what I was looking for, an estimated number on March 31st. So once again, let's recap what we've done over here. Net sales minus cost of goods sold gives us gross profit. What I know definitely is my net sales. I know that based on past trend, gross profit is going to be 30%, which means cost of goods sold is going to be 70%. I estimated this number. This number was estimated over here at 651, and that's a number I bring down over here in order to estimate my ending inventory. Again, these numbers were all given to me. So this number is an estimate based on which I have the estimated ending inventory at $167,000. Now, how would this be different if I'm saying that my gross profit is 30% on cost? So what stays the same? Let's look at information that stays the same and information that is going to be different. So this part, basically, we're looking at all the same over here. What doesn't change is what these numbers are not going to change. Sales minus sales return is net sales. It is what it is. Those are those numbers. Same thing over here. What we have over here, this part is not going to change. So that's exactly the same. Cost of goods available for sale is 818. That doesn't change. So what changes is the rest of the numbers in terms of estimates. Now, here I said I had gross profit was 30% on sales. Here I'm saying gross profit is 30%, but it is on cost, which means cost is 100%. So working backwards, that would then mean my sales is $130,000. There are many different ways in which you can proceed with the problem. The easiest way to understand this is if you can bring these numbers back to sales being 100%. So how do I change this to be 100%? Any number divided by itself will give you 1, which is 100%. So 130 divided by 130 will give me the 100% I desire. Now I need to do the same across the board. That's a simple rule in arithmetic. So 100 divided by 130 will give me 77, and 30 divided by 130 will give me 23. So all of these numbers were divided by 130 in order to make the sales number 100. Now once I have this, I don't need to worry about this anymore. Okay, so I'm not going to look at this anymore. So I'm going to strike out those numbers simply to say, don't look at that anymore. This is what we're going to look at. So as we had done before, 77% of 930 is my estimated cost of goods sold. 23% of 930 is my estimated gross profit. This number that I have over here, again highlighting it, I bring that down over here now. 716,110. The plug number then would be my ending inventory, the estimate, 101,900. So once again, net sales less cost of goods sold gives you gross profit. And over here, beginning inventory plus net purchases gives you cost of goods available for sale. Cost of goods available for sale less ending inventory gives you cost of goods sold. If I can come up with the estimated cost of goods sold, I can plug the number in over here and get the final number that I want, the ending inventory. So once again, what we have looked at over here is an estimation method of arriving at our ending inventory number. This can be done if the gross profit ratio tends to stay the same year after year. So with that, we conclude this video. And the next one we're going to talk about is retail inventory method.